right, another big earnings week this week with a shift in focus from tech to the consumer. A slew of names reporting, giving investors a better look at how consumers are spending. To break it all down, the biggest risks right now to the market, we want to bring in Samana, Wells Fargo Investment Institute Senior Global Market Strategist. Samir, it's great to have you here. So first, let's just take a step back and take a look at where we are trading today with the Dow, the S&P, and NASDAQ not too far from those record highs. What do you make of today's valuation and whether or not maybe we could see some profit taking at this point?
Yeah, I mean, that's a great point. I mean, we would say you're probably a little bit above fair value. Our year-end target is 5,100 to 5,300 for the S&P. So, again, we're kind of right smack dab in the middle of it, which tells me that there's maybe a little bit of asymmetric risk to the downside, just given some of the events that are out there, right? You could still have, tensions kind of flare up in the Middle East. You could still have the Fed disappoint and not cut at all. You could have some combination of economic data that, kind of rolls over without inflation kind of cooling off. So I think there's just a lot of different risks that, if you can take some chips off the table at the all-time highs, it's a pretty good idea.
I mean, just reading through some of the review and statistics coming out of this earnings season, Samir, I was looking at some of the FactSet data, and it's really showing that companies and the market right now is rewarding positive earnings surprises less than average here. And that also means that they could be punishing some of those negative earnings surprises a little bit more, typically seeing an average price decrease for companies who report negative earnings surprises for the first quarter of 2024 with a price decrease of about 3.3% 2 days before the earnings release through 2 days after the release. And so that's larger than the 5-year average. I mean, what does that all tell you about what investors are looking for in some of the reports coming through over this season and the forecast even into the rest of the year?
I think what they're looking for is a pullback, right? I think what they notice is a market that's only gone in one direction. I think it makes them nervous because I think it probably means that a lot of players have forgotten what volatility looks like. And it tells me that, with all the events that are out there, like the elections, like some of the currency volatility that we've seen recently, it tells me that a lot of people would probably head for the exits all at once, leading to episodic volatility. And so I think there's a lot of investors saying, you know what? This may be near term, as good as it gets. And so unless earnings are just blowout, or unless the stock has pulled back before those earnings, which leaves some room for upside surprises, I think they're just saying, look, I'll just kind of take my money. You just mentioned Buffett and his largest holding, right? Again, he's not bearish on it, but he's taking some profits. And again, there's nothing wrong with that.
So then where does that leave just the investment opportunity that you're seeing right now? When you talk about the outperformance or recent outperformance that we've seen in a handful of tech names, when you talk about the outperformance in communication services, is it time maybe to rotate out of some of those top performing names?
We haven't liked those for a while. Now we are neutral, so those are full weightings. But what we came into the year with was energy, materials, industrials, and healthcare. And 3 of those 4 have done really well, especially recently with kind of inflation expectations having ticked back up. From a timing standpoint, I think energy makes a lot of sense. You've seen oil kind of dip back down to below 80. And I think healthcare makes a lot of sense. There's a lot of kind of meta trends that are going on there that are maybe underappreciated and then otherwise, kind of sluggish market.
And so additionally here, as we're thinking about what the theme of this earnings season will have to really kind of signal about the rest of this year and outlasting some of the larger catalysts that could actually push markets to the downside, i.e. rate cuts and not getting as many as the market anticipated or none, as we've increasingly discussed, and then the election as well here. Where does that leave some of the company executives in this near term and the spending decisions that many of them are still making, especially on the generative AI front right now?
So you're seeing extreme amounts of caution, especially on the labor side. And I think elsewhere, you're also seeing quite a drive for efficiency. So what that tells me is corporations are getting ready for possibly two-way risk. Again, you do have elections coming up. You do have, rates that have been high now for a couple of years, which are starting to weigh on the consumer. A lot of the consumer-oriented companies have mentioned that caution on the part of consumers. So I think companies are getting ready for, again, just kind of that two-way risk. I think, unfortunately, investors aren't quite yet ready for it.
Samana, who is the Wells Fargo Investment Institute's Senior Global Market Strategist. Thanks so much for kicking off the week with us.
Thank you.